right, so very good afternoon to you. Let's start this third topic today, which is about the executive remuneration and the corporate governance mechanisms. And the background of the executive compensation is that in many ways you can relate the executive compensation as a part of the principal and the agent relationship that we study extensively in the agency theory. But the fact of the matter is that you can also relate this topic to the other very pressing theory that we studied was resource dependence theory as well. So executive compensation is a topic which fits very well into both theories. We studied that the one reason we have the agency cost was the information asymmetry, which arises because of the ownership and control separation. And when the principal and the agent, they start following the diverse utility function, and if it happens that they both are at the crossroad of one another. Executive compensation, which we study, is basically can be fixed and the variable. If you get a chance to go to the corporate governance section of the annual report of any company, for example, like last time when we met last week, we did see some facts from the corporate governance section of the Finnair, I guess. So if you happen to go to Finnair's website again, their annual report again, and if you get a chance to go to the corporate governance section, you will see that the top managers, especially the CEO and the other executive directors, their compensation can be split into fixed and a variable component. The fixed component, you know that it's like a non-performance based pay, but the variable component is very much based on the performance based compensation. So because it's variable, so its share can also vary. So if it is linked to the company's performance, it means that if the company is performing well, your compensation would be as promised. But as the company is losing out in terms of its market performance vis-a-vis its competitors, then the CEO and the other managers, they also have to give up the relative share because they were not able to meet the expectation of the company. So the first thing about the executive compensation is that this is an offshoot of the theories that we studied. And secondly, this is a outcome of the principal and the agent conflict primarily. And then the compensation which the top executive get could be bifurcated into fixed and the variable components. So that's something we need to know. But when we start this first slide, we come across a challenge. And the challenge is that alignment of utility function of the principal and the agent is a big problem. So unless there is a complete alignment, which would never happen, why it will never happen? Because we discussed quite extensively that the agency cost has three components. You have the monitoring cost, then there's a bonding cost, and then this third component is called residual loss or the residual cost, which cannot be contracted because there's always the information asymmetry in favor of the agent. And that's because of this information asymmetry, the agent will always have the last laugh. So therefore, it's not possible to align the utility function of both principal and agent fully. Therefore, the first trouble we come across is that if you think that by having the ideal compensation contract, you can get rid of the agency cost, then it's not true, because that's not going to happen, because there's always a leeway in the hands of the agent, which would make him or her above the other stakeholders. Okay, so that's the first point of the executive compensation. It's a background, and we also have this first challenge. The discussion continues. The executive compensation is a corporate governance mechanism which is meant to align the utility function of the principal and the agent. It reduces the moral hazard and the adverse selection. Now I will take a small pause, or rather not, but I want to ask you that, have you heard these terms before, moral hazard and adverse selection? If you, yeah, please, go on. Somebody was going to say about moral hazard and adverse selection. What are these two terms?
Yeah, moral hazard is when you enter into a contractual obligation with a party, and there is a risk that after entering into the contract, the other party will tend to go into some other ventures that might harm the contract.
Okay.
Yeah.
And yeah, that's a good point. What about the adverse selection? What is that?
Adverse selection will be the risk of selecting a party to a contract who might already be engaged in another activity that might be harmful to the contractual obligation.
Well, that's a good description, but the way I sometimes see the moral hazard and adverse selection is that the moral hazard, as you said, that you recruit, the principal is recruiting an agent, and it's assumed that the agent would be working for the benefit of the company, for the enterprise value maximization. But what the agent is doing, that he or she is engaged in some projects which are at the expense of the company he or she is serving. So you are in the office hours, you may be running your own consultancy or something. You're doing some work which, so the time which is meant to be spent on the corporate affairs, you are doing something else, basically. That's the one example. And the adverse selection is that you made some claims during the time of your selection, but actually when you are put to work, you are not able to deliver those expectations, or you have chosen the projects which are adverse from the company's, orientation point of view. So it doesn't fit in the company's main profile. And this is only possible when the information asymmetry is tilted in favor of the agent. I hope it makes sense. So
yeah, yes, it does.
Yeah. So the executive compensation as a corporate governance mechanism, it should be corporate governance mechanism, aims to reduce the, why not eliminate, because we know that we can't eliminate the agency cost fully. The risk which the company is exposed to, among other things. Yeah, but we have a discussion about it, the risk. And so the challenge is that if we ever assume that the compensation, executive compensation as a corporate governance mechanism is able to eliminate the entire cost, the agency cost, that's not true, because some component of agency cost will always work. We discussed it many times. So what can we do? Can we link the pay with the performance? Okay. So should we link the pay with the risk, for example? Because if you link the pay with the performance, then on the one hand, we assume that the agent would work hard in the interest of the company, and the company's performance will go up. But on the other hand, company performance is very risky in many ways. If those risks are controlled by the agent, then it's worth compensating the agent for controlling those risks. But just imagine that the agent has no control over those risks, then why are we paying him or her for it? Like, for example, in finance, we study that the risks are of two types, the systematic risk and the unsystematic risk. The systematic risk, they come from outside. They are basically macroeconomic factors, like change in inflation. The interest rate can fluctuate. The GDP forecast can vary. And because of these macroeconomic variables, they are susceptible to change. Therefore, they can pose a risk to the company. Okay. The question is that, is agent even capable of, minimizing those risks? Can he stop the risk? Can he come as a shield between the company and those risks? So, for example, my simple question to you can be: can CEO can he stop inflation? Can he stop change? These are macroeconomic factors. If there is a COVID-19, then it doesn't matter how great CEO you are. All your strategies have come cropper. They just fall in the dust. It doesn't make any sense. So if you think that the corporate governance mechanism, the executive compensation, as a part of the corporate governance mechanism can align, can motivate the firm managers to stop the risk exposure of the firm, then again, that is not a problem. That is not plausible. It's not really thinkable, because many risks are controllable and many risks are uncontrollable. Of course, there are some risks which he can control over. Like, for example, there's some specific risk which the company faces, what we call as an unsystematic risk, which come because of the bad control. So if you can improve the company's internal control, if the company can do better negotiation with its investors and the other stakeholders, if a company can do some R&D, keeping pace with the time, launching a better product mix. So if these kind of things you are able to do, then you are, as a CEO, you are able to serve as a risk minimization mechanism. But these are not the only risks you face. There are some risks which are beyond the four walls of the company and which you have no control over. And if you have no control over, why would you be paid based on those risks? For example, you are my students and you'll be sitting in the exam. And because you'll be writing the exam, you'll be graded based on your performance. But if I say that, hey, the grades will be based on the temperature on the day of exam, so you have no control over it. So if you have no control over it, why would I give you the grades based on that? So that's something which is a bit conceptually. It can be a practical arrangement. It can be sort of a working arrangement. But when you start digging it and you start finding what is the theory, what is the sense behind it, then you start doubting that if this way of rewarding the manager, is it even rational? Is it even theoretically or conceptually sense making? So, well, then the challenge is that how to find the reliable performance measures, because we don't have the reliable performance measures to it. We have the performance measures, but they themselves have their own problems as we go to the next slide. But the question at this moment, I'm discussing that, do we have any performance measures, especially with respect to the risk, which you can relate it. Even the risk profile of the board of directors, of the company's main shareholders and CEO, even that is not common. So they think differently with respect to risk. Whether who is more risk lover who is more risk averse and who is risk hater. Even that is not common between the principal and the agent. So if I ask you this question, that who you think is more risk lover and who do you think is more risk averse between the principal and the agent, what would you say? So who do you think is risk lover between principal and the agent?
Maybe the agent.
Agent is risk lover. Could you say more about it?
Because they are acting on instead of others, so it's not so personal, perhaps.
Okay, so that makes them more risk lover, yeah? Okay. Anybody else has an opinion about it? Who you think is more risk lover? Principal or the agent?
It's the agent.
Is more risk lover?
Yes.
Could you say, to back up your comment?
I think because their compensation is tied to the performance of the principal.
So your assumption is that if you're a risk lover, then you perform more, yeah?
Yeah, because their compensation is tied to the performance of their principal they are representing. So I think they are willing to take more risks.
Wait a sec. If you are a CEO of a company and 90% of your compensation will come from the company's performance. So if the company doesn't perform well, if you take a very risky project and the company doesn't perform well, there is a chance that you may lose a substantial part of your pay. Will you still be risk lover?
No.
So you will not be, yeah? You like to play safe?
I won't be, but also I'll be motivated to take more risks for the company.
But see what, now we are comparing between the principal and the agent. So the answer I'm seeking from you is not in the absolute sense, but in the comparative sense, that comparatively, okay, all right, you know, if you are a CEO of an IT company, you will not get more compensation by not investing money in the R&D and keeping all the money in the bank account and just earn 0.1% interest a year. No, that's not going to happen. You have to invest, you have to take risk. The question is that, what is your risk pattern? Are you going for all out risk? Are you very risk lover? You are going for all risk lower kind of strategy, or are you more calculative, more cautious? Even though you are a CEO of a growth company, you still are risk averse, basically. That's the point.
Yeah, I think you would be risk averse.
Because the reason why would you be risk averse, and I believe that you will be risk averse, is that definitely the shareholder who have invested in the growth company, they want their wealth to grow fast. And that's precisely the reason they have invested in your company. Otherwise, they would invest in some retail store or in some utility company. Okay, but now you have to be careful that, are you going to be bow down? Are you going to be totally, lean to their so-called wishes and start undertaking the projects which pushes the risk profile of the company substantially high? That could be suicidal, actually, in many ways. And don't forget one more thing. The investors of your company are assumed to be well-diversified investors. You know the meaning of well-diversified investors? that they have not invested all the money they have in your company. But being a CEO, this is your only job. So basically, you have invested all your skill, reputation, everything in one company. So you're basically, for the agent, the investment portfolio is the company where he or she is working in. On the other hand, the investors, they have a portfolio which is far more diversified than the agent does have. So then who would be, comparatively, who would be risk lover and who would be risk averse now? Being an investor, if you lose some money, you lose a certain fraction of your money. But if the agent loses what he loses his full job. So you don't lose 1/10 of your job. You lose job, basically. So either you're working or you're not working. So that makes the agent more risk averse comparatively. So here it's very important for the agent in the board of directors meeting to satisfy these high flyer investors to keep the nerves calm. It's very important. Yeah, make sense?
Yes.
Okay. Yeah, and then we know that the performance measures could be input oriented and output oriented. When you say input oriented, it means that how much efforts you put in. And when it comes to the output oriented, it depends upon how much performance comes. For the top jobs, for the highly skilled jobs, for the jobs entailing huge amount of responsibilities and complexities, it's not possible to link performance, link the compensation with the inputs. For some comparatively low-skilled jobs, it's okay. Like I remember when I used to work in Britain in Marks and Spencer as the sales, the customer advisor, and I used to be on the till point. I was paid on hourly basis, certain X amount of pounds based on hours. So it was like input based, how much time I spend in my job. So if I work for 5 hours, I'll be paid 5 hours multiplied by the hourly wage rate. So it was very input oriented. There was no substantial output based something, unless I'm able to sell some gift cards to the customers, unless I'm able to sell them some customer fidelity card along with the products, but even that was very insignificant part. So it depends upon the type of job. If you're working as a top CEO, top executive director of a company, that job cannot be measured with the amount of time or amount of efforts. It has to be reflective. It has to be output oriented, not inflective, but reflective. So it has to be some performance based measure. Then the performance based measures, they are actually based on the accounting and the market performance based measures. Accounting profits, we know that is subject to manipulation. There is lots of, even though some of those manipulation can be legal according to those accounting rules and laws, but still there's a possibility that there is an agenda of manipulating those statements. So for example, in your Moodle, I have attached 2 files. One is the net present value and the depreciation. So there are 2 files there. And you will find that the company would have the different findings just by changing a small accounting policy. So even though nothing changes, so there are 2 situations. In both situations, all the numbers are same. Nothing changes on surface in reality, but just by changing the accounting policy, you can produce completely different results, because the accounting numbers we know that are subject to manipulation. And in fact, in your readings, I made a point that I put some articles which are about the manipulation or manipulatability of the accounting numbers, and how well you can manipulate the accounting numbers. There is one article, accounting is broken, and then a couple of articles on the corporate corruption. And one of my articles is there about the the quality of financial reporting in case of India, that how you can manipulate the data, and your discretionary accruals could change depending upon how the type of accounting policy you follow. So there is a problem with the accounting number. Okay, and moreover, accounting number are historic. I want to give my, if I'm the decider of giving compensation to somebody, of course I would look at the historic numbers, but I would also be more futuristic, that what compensation today, so that today's compensation which I give to you, and not only is a reward or acknowledgement of your past actions, but it also speaks about the motivation I want to give to you for the tomorrow's performance. But unfortunately, the accounting numbers which used as a criteria is more like historic, so they're not futuristic. The futuristic performance measure can be the market, the stock market based performance measure. That, okay, all right, I set a benchmark that next year you will get 10% rise if you are able to push the company's stock price consistently 10% than the level we have today. So you set a bar. All right, it's futuristic, but the question is that, do you have control over these factors? You don't have the stock market performance is not, of course, your own performance, you mean the CEO, make an impact on the company's stock price, but that's not everything. There are many factors, there are many independent variables which have an impact on the stock price. One of the independent variables could be the efforts and the orientation and the reputational capital of the top managers or even the independent board of directors, but that's not everything. To a large extent, the stock price movement is impacted by the macroeconomic factors. There are political factors, and there are several other factors which could be beyond your your expectations. So these absolute measures, whether it's accounting or its market performance, is kind of it's not flawless. Of course, we use them. If you ask me, all the companies in the world, the listed companies in the world, they use these measures for sure. But these are not foolproof. That's my point. Okay, so we go on to the next point. So the absolute measures, they have some issues. Can we have the relative measures of performance? So rather than the absolute measures are basically when the company's performance is, the benchmarks are set internally within the company. But here, when I say relative performance measures, it means that the company's performance benchmarks are set against the whole market or the index. So for instance, it could be that the company CEO's compensation is linked to the stock market index. So if the stock market index, which is not just one company, but the whole market, so your performance-based pay is connected to the market performance benchmark. So if it goes up, you get more. If it gets less, you get less. But again, there is a problem, because if there is I gave this example here, that if there is an index that goes down by 3%, okay, and the company's performance, the company which you are leading, the performance go down by 1.5%, then even though in the absolute sense, your company's performance has gone down, so according to the absolute performance benchmarks, there should be a cut on your performance-based pay. But what has happened? When you compare this 3 and this 1.5, you have, despite absolutely the market is down, but in comparative sense, you have overperformed, doubled than the market. So even though the company stock price is going down, you deserve bonuses. On the contrary, if the market is increasing by 3%, whereas the company you are heading, the stock is going up by 1.5%. So in that case, you should be not rewarded, but instead you should be penalized because you have underperformed twice, even though the market is going up. So these kind of measures we need to apply. In theory, it sounds very good, but practically it's not very good because it's not very practical because if you are paid according to the market benchmark, then the problem is that the companies will be more indulged not to increase their performance, but on the contrary, they will be more engaged in sabotaging the performance of their competitors, so that if their sabotage, if their unhealthy practices are able to reduce the performance of your competitors, then the company which you are leading, the benchmark goes down, basically. So you can easily cross over, you can easily jump over that benchmark according to the relative. So that is a big problem. In theory, I like personally these relative performance measures, but the problem is that this can generate unhealthy competition and the corporate rivalry can become, a norm. Already we are having this problem that the companies are so big and they are sharing the market, which is fixed, and then they are hell-bent upon doing anything and everything to increase their share. Now you see that the whole world is reeling under COVID-19. The market sentiment is very bad. The companies have a lot of unsold stock and they just want to grab the market, but the size of the market has shrunk. Some of the countries have lost their 1/4 of GDP already. So what do you expect? So that creates very limited opportunities for the companies in question. And those companies, because now the size of the cake, the size of the market is shrunk, they can do anything and everything to grab the market share, and they will not hesitate from going into these unhealthy, unscrupulous practices, which is not very good for the business environment. They will go for all types of price and non-price competition, and even beyond that, those kind of when you are really sabotaging something. So the corporate espionage, the corporate sabotage are now very important reality in the life. So we have to live with it. So that's the problem of the relative performance benchmark. You have any questions so far? Then we go to the next section of this topic, the pay performance sensitivities and the compensation model. Well, this is the model which I want to discuss with you. When I discuss this thing, then these two slides which I skipped, they will automatically be covered in this. So you see here that on the x-axis, I have written the performance measures, and you can see that there are certain minimum performance measures, which is called the threshold performance measure. And then there is a target performance measure. That, okay, this is the minimum you should produce, but there is a target. For example, you must not produce less than 3% increase in the stock price, for example, but the target is to increase the stock price to 8%. Okay. And here you see that when you are able to meet, or you are not able to meet the threshold performance, you get the base pay. And if you consistently meet only threshold performance, then you are given some rise above the base pay, which is a very kind of threshold bonus. But the real show is in this range. Here is the real show. That here, if you are able to, if this is the target, then you are able to achieve more than the target then in the absolute amount, you will get more compensation and so on and so forth. So basically this line, you can see, is your true performance zone. This is called incentive zone or the performance zone. And here you can see that this line is a straight line. Of course, in the reality, the line is more curved. You know, it could be concave to the origin or convex to the origin, okay? But I would say that it sounds more like concave to the origin, that first of all, when you are able to meet the pay performance sensitivities, your bonuses rise more proportionately, but eventually it slows down. But anyway, even if this is a straight line, it has a slope. And you can see that what is the angle? If I draw an angle here, if I extend this dotted line further up, there would be an angle here. I don't know if it is 45 degree or what, but point I'm trying to make is that if you are a company which is really incentive oriented, then your curve, this straight line, should be like this. Can you see the cursor is moving here? Can you see it?
Yes.
Yeah. So
Yes.
if the company is more incentive driven, then this line, its slope would be more. More slope means it would be like this. So I would say that if the company is a IT, biotech, these kind of growth company, then this line would be like this. On the contrary, if the company is more like a utility or some public sector kind of organized, like safe play, then the slope of this line would be like this. So depending upon the nature of the business and the nature of the contract, the slope of this line signifying the incentive zone where you are able to get incentivized would vary. And here there is a kind of, you can say that this is the true pay performance relationship. And the performance benchmarks, we discussed that they could be either accounting or market, stock market, or hybrid, like TobinQ we use, or even you can include some non-financial measures into it, like R&D and these kind of activities. So whether you take one measures or you take more measures or you create some kind of matrix, so we have those performance benchmarks, and based on that you are paid. So this is where in the typical American companies, your 70% to 90% of compensation depends. And then at a very later stage of a career, you see that there is a pay cap, there's a bonus cap on it, that your salary is already so high that maybe the regulator put a limit that, hey, you know what, when you reach the top, when you reach the height, then at some stage, your pay performance relationship cannot go endlessly. It can't be like this forever. So you have to put a cap on the compensation that, you know what, this is the maximum. You've been doing great job, keep doing it. But you already earn so much that we can't allow you to get more bonus. So there could be bonus cap here. But believe me, not every CEO would reach this stage ever. There are very few people who can hit the roof basically, and they say, and then come the regulator that, you know what, we don't want to give you more compensation because this is already too high. Yeah. You are the world's highest paid CEO, no more increase. So this is a typical compensation model. We have a threshold performance, which at least that much you're expected to achieve. And then attached to that is the base pay. And then there is a performance-based pay as well. The concept of performance-based pay is also has come out of a crisis, basically. The crisis is that I think it was President Nixon in the US who passed the bill that if you, maybe this point is in slide somewhere, I don't know where, but it should be there, who passed a bill when President Nixon was, I think he was in the 70s and maybe, yeah, I think he was in the 70s, the president of USA. At that time, he set a bar that you cannot show any salary to the top manager more than 1 million. Was it 1 million or something like that? Let me check. But there was a limit up to which. Oh yeah, it was it was President Clinton. Sorry, not Nixon. Graf Crystal bill, and which says that any compensation more than 1 million, any kind of cash or non-performance based pay, if you give more than 1 million to your top manager, you cannot show it as expense and claim the tax benefit. So for example, if you happen to pay 2 million to your CEO, then in your income statement, when you show it as expense, you cannot take more than 1 million to it, because if you put 2 million, then you show less profits and you pay less taxes. So basically, you pay more to your executive, but you are basically putting the burden on taxman. Right? So because of this limit, many companies were very, upset. And those companies who chose to reduce the pay of the CEO and the top managers, they could see there is a migration of, there is a turnover of top managers. They were leaving the jobs, and this was creating a sort of managerial crisis for the American companies. And then they decided, okay, all right, we don't pay you hard cash, we don't pay you the non-performance based pay, but let's give you more through the incentive zone. Let's link your pay to the performance. And this this was like a Pandora's box, basically. And so much so that the CEO, at the end of the day, they started getting more money from the company through the hybrid, the base pay plus the performance-based pay altogether, than what they used to get based on the base salary. So in fact, it was not very successful thing, because the idea was to reduce the pay package of the top managers, but actually the managers, they were able to get far more than what they used to get before. Okay, so sometimes the lawmakers can be outwitted by the corporate people. So here we go. And you can see one example I gave you, Jensen and Murphy, they're gurus in corporate finance and corporate governance. They did a sort of survey a long time back, because in 1990, this report was published, their article was published, so the data is very old. But the beauty of this article is that I want to show you that how less the compensation was connected to the performance based during 80s. And you can see that at that time, the pay performance sensitivity, or the slope at which you are paid, was actually 3.25 divided by 1,000, which makes it very small slope, almost flat to the x-axis. So in other words, if a CEO is contributing $1,000 additional to the company, then the performance-based pay will only be 3.25. So if you divide 3.25 by 1,000, this is, how much is this? This is 0.003, almost zero. So in other words, when Jensen Murphy published this report, at that time, this slope was almost zero. So it means that for the top American companies until 80s, this slope was very, very less, very small. But because the base pay was very high at that time, and this is why President Clinton wanted to reduce it. But then came this idea that, hey, if we can reduce this, no problem. Let's make it small, but make this one sharp. So raise the slope up, so that if they are losing out here, then they are able to get more from the performance-based compensation. So this is the model of the executive compensation. Yeah, any questions, comments? Okay. So salary is, of course, one part we discussed. Yeah, so as I said, that was this President Clinton's move successful? No, it was not, because then the pay, the compensation professionals who are who make this kind of what is called the compensation consultancies, they develop better ways to reward the managers, and that included the guaranteed bonuses. All right, so the company perform and doesn't perform, you'll get the minimum guaranteed bonuses. Deferred compensation, that okay, all right, if your pay is connected to performance and the company is performing bad, you don't lose the compensation altogether, just postpone it for the next year. So if I say so, that deferred compensation is that your board of directors is giving you a target of producing 7% return, but you are able to produce only 5%. Hence, you lose in the competition. You are below par performer. But you don't lose all the bonuses. You lose fraction of it. And when in the next year, you overperform, okay, you not only get the overperformance reward, but you can also recover the bonuses you lost last year. So you can basically recoup or recover your compensation. Your present bad performance compensation loss can be recovered from the future better performance year. Or there are enhanced pensions. The pensions can be increased substantially, and usually there are many ways you can camouflage, you can hide the amount of pensions from showing in the annual reports, even though the law is quite strict, but still people can do it. Or you get some perquisites, which means some fringe benefits or some extra benefits, like non-cash or non-compensation type of benefits, like not the bonus type, but you can get the company house for the whole life, or you can get some other, the in-kind rewards, etc. Okay, so if there's no question or anything, then we take a short break for 2-3 minutes, and then we carry on the next slides. So we take a very short break and come back. The bonuses, which are self-explanatory, they are basically to align the interest of the managers with that of the company. They can be based on performance or non-performance, as you saw in the compensation model, that some bonuses are the threshold bonuses, which means if you are just able to meet the targets, or not targets, but very minimum targets, then you get some, and you meet those minimum targets very consistently, only then you get some threshold bonus. But the threshold bonus is more like a non-performance bonus, because you just achieved the bare minimum. But then here, you get the base salary plus the target bonuses. So this is the real performance-based bonuses which you get. The stock options are good. You get the stock options. Do you know the stock options? Are you guys aware of stock options? Have you studied any course about the options, etc.?
Yes.
Okay, so do you know how the stock options work in the context of, we use the phrase ESOPs. I think it's like an employees stock option, some program or something, where the compensation is given in the form of options to you. Let me explain it to you. I have to share now the whiteboard. The option is that the text, okay. The option is, this would be good to zoom in. The option is, there is a strike price. Sometimes some books call it exercise price. And let's say that is fixed equal to 10 euros, which basically means that you as a CEO have the right to buy the strike price. You have the right to buy the share of the company you serve for 10 euros after a year, yeah? And the current stock price is, let's say, is equal to euro 8, right? And at the end of the year-ending price is 12. That's what you produce. Let's assume that it's because of your hard work. So whereas everybody else is paying 12 euros to buy the company share, but you can get it for 10 euros. It means you can get for 10 and sell for 12. So for every share, you get $2. You can call it capital gain. Is 2 euros, sorry, yeah. And if you have, if the company has given you 1 million shares, 1 million shares as compensation, then you as a CEO will gain 2 million as the bonus under ESOP. Okay, but what if the stock price is not 12? Can I copy it? Well, maybe I do it. But what if the can I change the color of it? I'm a bit unsure. I rather don't take any chance. So if the year-ending price is 9, then you lose the battle basically. Or let's say 10, yeah? Let's say 10. You're meant to make it, yeah. So no, it's 8, rather it's 7. So you're losing because the minimum you get is for 8. The minimum price, the price at which you are entitled, you mean the CEO is entitled to get the share from the company is 8 euros. But actually the market price is below that. So why would you exercise your 1 million shares as compensation? Why would you pay 8 million to the company and sell them for 7 million in the market? So this is a loss. It means that the agent, the manager, is penalized for the company's poor market performance. Even though I would give a disclaimer, and I've told many times today, that the stock price is not just something which the CEO has a control over. The stock price is motivated, is affected by a series of determinants, which are, most of them are out of the reach of the top manager. So it's not, they have no control over it, or at least they have very minimum control over it. So linking the compensation on something you don't have control over itself is faulty. It's not very foolproof way of, it's not very theoretically is very valid. But anyways, here the CEO has lost 1 million euros. But you know what? There is one corporate corruption which you can indulge in. And what you can do is that when you think that you're losing and you are a very strong CEO, you can reprice. You can reprice, you can use your impact, you can use your influence, and you can, or you can do some threatening, whatever you can do. There will be a lot of boardroom drama, and you can force your board to reprice it to 5 euros. Now, when you compare 5 euros to 7 euros, you end up getting 2 million via ESOPs. So this is corruption. This is corporate corruption. So when you are not able to overperform the benchmark, you can lower the benchmark. So it's like a hurdle race. If you're not able to jump over the hurdle, okay, all right, lower the hurdle so that you declare yourself as a winner. So this is something which is very dangerous, and the companies have been doing it in the past, even though the regulation system is very strict. But believe me, there are still many loopholes. There are many ways that you can reprice the compensation, even though this data is shown in the compensation tables, but still there's a room for dilly-dallying these numbers, believe me. Yeah, so this is how, even though the company's CEO feel, first of all, this very institution of benchmarking is not foolproof. But secondly, even if it is, and whatever the rule of the game are, you lose, you win, you win, you lose, then you can change the strike price to, you know, so it should be here, not here. So the reprice should be reprice is, for example, so this number should be here, yeah. Let me see, 10 is the minimum. The current stock is 8. The year ending is 12. So 12 minus 10 is 10. 12 minus 10 is 2. Yeah, this is fine. And if you have 1 million, then you get, but if the year ending price is 7, so basically you lose out 7 minus 10. So it's like saying that you buy a stock from the company for 10 and sell in the market for 7. So why would you do it? So basically you're losing minus 3. So rather than losing 3 million, you just give up your 1 million shares. So you say, okay, I didn't get them. But if you reprice it to 5, then you seem to have overperformed. So you are able to get it. So this is something, this is sheer corruption, basically. What else will you call? This is a daylight cheating. The question is that, is the existing corporate governance system able to solve this problem or not? Well, the regulations are getting stronger and stronger, but are they getting even effective? So there is, just having a bill or a new law or new rule doesn't guarantee that the law is also implemented properly. So this is what we do, or this is what we shouldn't do. Questions, comments? Like I wrote here, low strike price. So you can, if you're losing out, then you can lower the strike price, because sometimes the CEO is so powerful and he can actually basically intimidate the board of directors that, okay, all right, if you do like this, if I'm losing money, you see, I've been working hard and you want to lose out money, come on, is it my fault that the stock price is low? And then there is some kind of consolation. Oh, yes, no problem, no worries, don't worry. We'll do something to accommodate you, and then let's reprice the options. So this is how things go. In the strong regulated markets, maybe this incidence could be of small scale, but of course, I will not rule out at all. Yeah. Any comments? Okay, if not, then we go on. The long-term incentives are there. Okay, the long-term incentive, the researchers, they argue that they should be as relative, and they should be connected to the market index, the sector index. And I think we also discussed some time ago before the break that the relative index is better because it filters out the possibility of manipulation. But the problem with the market or the sector index is that there could be some more conflict arising among the companies. And okay, for example, in 2001, the data shows that only 5% of the 250 largest US public listed companies use some kind of relative measure. They still use those old-fashioned absolute measures. That's a challenge. And then there is a little bit of different dimension that you have to be careful of certain reactions. And the one reaction is that if you are a risk-averse manager, then you'll be very careful of paying to yourself the higher cash salaries than options. You may choose the options path because there is a risk in the options of losing. So at least it shows to the stakeholders or the investors that as a CEO, you are not putting all the risk on the shareholders, okay, or the other stakeholders, but you are also taking the risk. But if you are paying yourself with the outright cash, then there would be outrage cost against you. The financial media would be writing something against you that you, instead of investing in the company stocks or company's projects or any R&D or the new machinery or the new plant, you are using that money to pay yourself. And that would be very outrageous. That the market reaction would be very, you know, and that would be actions. So for example, I gave an example here, late Steve Jobs obtained an option package over $500 million. And it was not very much in the picture. It was not so much debated by the media, the financial media. But had it been was cash, Steve Jobs have to give so many explanations, and he would have felt very uncomfortable in facing the media and the lawmakers. Okay, so it's easy to camouflage. It's easy to hide the options if you, in comparison to the cash. This is old data, but I just want to say that the European CEO, I took the UK CEO, not even the European, because the UK CEOs are far more closer to the American counterparts, because the non-UK, well, UK is, okay, let's not go into the politics, but the non-UK European companies, there the CEO is anyway less powerful. So I think the UK CEO is somewhat who's more powerful than the other European counterparts and comparable to the US CEO. And here we see that if you look at the UK top 500 companies CEOs pay package, that is below the US small cap pay package CEO. This data is old, but believe me, the trend has not changed much. So if you compare the UK top 500 the top UK CEOs, and you compare with the top American company, you see the difference between the pay package. So much so that even the small cap companies in the US, their CEOs are getting more money, more salary than the UK top 500. I remember one example, it was about 10 years ago, if I'm not wrong. That time, the highest paid UK CEO was the CEO of Sky Broadcasting. Okay. And if there is an experiment that all the top paid CEOs are standing in a queue, starting from the highest to the lowest, then the highest paid CEO of UK's company, Sky Broadcasting, would be standing 97th in the queue. It means that there are 96 CEOs who are paid more than him. And invariably, those CEOs were in the US, coming from the small cap, mid cap, and of course, the highest, the top cap companies as well. So much is the pay gap between the American and this goes to the idea of that in the UK, the ownership structure is very, or in the Europe, the ownership structure is very thick, and that puts a lot of check on the CEOs. And whereas in the US, the ownership structure is very fluid and very thin, and that makes the CEO of the American companies very, very powerful. And also many American CEO, they are also the chairperson of the company as well. So it's like being the president and the prime minister of the country by the same person. So that makes them even more powerful. Okay. Read these articles, and I think you will find this. These are The Guardian is a very famous American Indian. What happened to me? Very famous British newspaper. Read this article and then see that how. So pauper, the beggar, very less paid, the poor person, how the British CEO are considered, and American. So here there's a comparison between American CEO vis-a-vis the German CEOs. And here is the prince that how well the American CEOs are paid. Okay. And the empirical research on the CEO compensation shows that there is a negative association between the remuneration and then there is a operating profit and the share performance. So if there is if the company's profits and the share performance, it goes up, then there is a negative. So this is the core et al. Find that there is a negative association, but that's not true for all the time. The global executive pay package is getting more convergent to the American style. So even if you look at the European companies, you will find that the CEOs are now getting more and more compensation in line with the American CEOs. So whereas the pay package of the European companies used to be very small in comparison to the American CEOs. But now the European companies are paying more because maybe they have no choice, because otherwise all this top managerial talent will migrate to the US, and they have actually. So it's not something will happen, but it has happened in the past that many European CEOs, they found better jobs in the US. Okay, and then these are some examples. So you can have a look at this. The average director's compensation in the 200 largest US company is this. Okay, whereas the Enron was paying almost more than 2 times. So too much of compensation when you are paying to your directors, okay, and that is not connected very well with the company's performance, it can ring the alarm bell that, hey, something is potentially wrong with the company. Okay, so that's what we need to be careful that when you look at if the company is paying a lot of money to its CEO and the top directors, then also see that is it falling in sync with the company's performance also or not? Believe me, no country in the world is free from these kind of dilly-dallying, and even the most honest countries in the world, even there, this performance exists. I remember in some of there have been some scams even in the Nordic countries about the compensation, that when the CEO were overpaid, way above what they should have been. If it was a fair pay, they would have get at least 50% less what they got. What can be done? Well, the market can do something. The market can be more active but the problem is that even the market system, the market mechanism is not able to do much because the modern day boards are staggered. Staggered means that if the CEO is paying too much to himself and there is a negative outrage, the outrage cost is going up. The financial media is against this CEO who is paying too much of cash to himself. The stock price is down, okay? And then there's some acquirer who is taking over this company. But the problem is that they cannot take over the whole board of directors. The reason is that in a typical company, you don't retire the whole board in a year. So elections are held every year in the AGM, but you only retire 1/3 of directors each year. So even if the acquirer replaces all the directors of his choice, the 2/3 of the board would be still loyal to the existing CEO, expectedly. Okay, so even if it is a takeover, the existing CEO or the existing board of directors, they do not lose the power immediately. So they're still very powerful. And moreover, the takeovers are often very expensive. And we have seen in case of, and you see the Babchuk's article is a fantastic article, if you happen to see it. And I give the example of Carl Icahn, who's a professional acquirer of the companies who are not very well governed. And often these takeovers are very expensive, and very often these hostile takeovers are like they're failing, and that causes a lot of problems. And I think the one reason of hostile takeovers being a failure is that the company or the person who leads this hostile takeover, if he wins, then everybody else wins. But if he loses, then only he loses. So that's a problem with these proxy fights. And moreover, these proxy fights are not very good sign of the corporate environment. It shows that there is, because the corporate system, the corporate environment, the business atmosphere should be very peaceful and amicable. And you can't allow these kind of proxy fight to happen every day. And then there's some public outrage also. So there is the media is getting strong. They are getting more active. And now there are so many NGOs and so many groups which are actively monitoring the activities, especially the financial gains which the top managers are deriving from their companies, especially after this financial crisis of 2007. Such organizations have become more active, and now they are even, I'm sure they are watching the executive compensation during this period because of this COVID-19. So if it happens that any CEO, whether he or she is getting more money than before, more compensation than before, or his bonuses are rising despite the dismal performance, of course, in the middle of COVID-19, or if his compensation sacrifice is not in line with the company's falling performance, in that case, there'll be a lot of new revelations that, hey, I think there is something wrong is going on. So there's always a public outrage, and why not? The public outrage is very important. But the managers can camouflage, so they can outwit these NGOs or these organizations who are chasing them. So there is one example that would prove the IBM CEO, the former Louis Chestnut, he retired. He was entitled for this 1.14 million annual compensation at the age of 60. The actuarial value of this annuity was based on 18 million. So based upon his salary, which he was getting 18 million a year in the past when he was working. And this compensation which he was getting, it was not included in the IBM's summary compensation table. So now the regulator wants that if such pension amount is given to the CEO, the ex-CEO, it should be shown in the summary table, but still this money can be understated because it's about some past activity, not the present activity. In 2001, when the one-year treasury bill was 3.39 to 4.63, both GE, General Electric, and Enron, they guaranteed executive 12% rate of return on the pension funds they had. So because they were contributing towards the pension, but their company was giving their CEOs 12%, whereas at that time, the risk-free rate was this much. And because these pension funds, they're invested in the risk-free funds, which are very well-renowned, they're not just junk, very well-renowned. So there's no reason of paying 3 times more than the risk-free rate of return. And there are many more examples. So you can see that in the red letters, I have given some examples that how you can dodge the public outrage. Public can have outrage, but I think the public may not have that much of insider information, and they may not have those sophisticated tools to detect. So therefore, it still gives a lot of leeway to the managers. Okay? And there are some more points which you can discuss. So that's everything about the executive compensation. Please go through it. This topic is very important. It's not difficult at all. It's very basic topic, but still it has very far-fetching implications. And now I want to make one announcement to you. And the announcement which I want to make is that next week when we meet on Monday, I want that you people discuss with me the key points of the articles which you have studied. So it will not be one-to-one discussion, but I just want that you share, and you don't have to present the whole review of literature. You don't have to. It will be very informal chit-chat. But I want that if you have noted some key interesting facts related to corporate governance, please share with everybody, and so that we can have some good discussion. Or if you came across some point which you didn't understand much, and if you want me to explain, or if you want somebody else to contribute to the discussion, let's do it. Of course, I will not be able to cover for every student, but let's do as much as we can within 2 hours. So in the next week, when we meet, I shall not start any new topic. So basically the topical discussion is over now. 3 topics we had, enough. And the next week when we meet, 3 topics my end, of course, then you have Lisa Kurunmaki's topics are also. So basically 4 topics, if you can say so. But next week when we meet, I will not start any new topical discussion, and everything there'll be just general informal discussion about the articles you have studied. You don't have to prepare any presentation for next week. You don't have to be very well prepared. Just write down some observations which you have noted down while reviewing those articles, and just bring the discussion. You can raise a point and also answer by yourself. You can also raise a point and invite others to take part in the discussion. Or if you have any direct question to me, you can do that also with reference to your reviewed articles. And that's it for now. I hope you understand my point.
Yes.
Yes, it's clear.
So it'll be very informal chit chat. And basically that's all we need to do. Very simple and short. Okay. So there we are. We are done now. And if you have questions, you can ask me. If not, then we will meet next week.